Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good to have you back on. Thanks for making time today.
Good afternoon.
Well, let's start with the outcome of this week's Federal Open Markets Committee. The Fed saying it's going to double the speed of its tapering of asset purchases, and that means it could be phased out by March instead of June. It also seems to be signaling as three or around that number of rate hikes next year, too. But the thinking is this won't have a huge impact on the financial markets here in Korea. What's your view of the situation?
Yes, the Federal Reserve have announced that at its December meeting that it would end its pandemic-era bond purchases by March of next year, pretty much accelerating the level of the bond purchasing program in terms of the tapering to $30 billion US dollars per month, which is about double of the previous of $15 billion per month. If that speed happens, then the tapering would be pretty much ending and it will be ended by March of 22. Also, if you look at the interest rate hike, they are expecting about 3 times of rate hike, so which means that right after the tapering is over, which will be March, so I guess once every quarter is most likely the case where they'll be raising interest rate. Also, it is expected that they'll be raising another 3 times of interest rate in year 2023, and then 2 times more the year after. So on a long-term trajectory, they're targeting about 2.5% interest rate environment in a longer-term basis. Obviously, this would have a negative implication in terms of liquidity condition in a global financial market. However, though, the level of speed is not that significantly faster than we've seen in the past, and usually the financial market do reasonably well when interest rate hikes are in a steady pace, not an accelerated pace, and that if that's the case, then if you look at the economic growth rate in general, raising interest rate means the economy is recovering. So therefore, market were pretty much taking this as a news that was expected, nothing more than that, and therefore most of the financial market did quite well right after this FOMC meeting.
Indeed, investors in the U.S. market seem to shrug off the news from the Fed. In fact, they may have liked the fact that it reduced some of the uncertainty. The markets started out lower on Wednesday, but ended up quite a bit higher. What's the story in the global markets?
Yes, as you said, if you look at the Monday and Tuesday and Wednesday, pretty much if you look at the NASDAQ, was down more than 1% every day. And then on the Wednesday, before the announcement by the FOMC, NASDAQ tanked by 2% plus. But as it ended well above 1.6%, which means that 3.6% swing from the bottom to top. So clearly, market took this news of the Fed tightening as something that was expected. So the overall market were taking pretty much that in terms of the inflationary pressure, in terms of economic recovery in the labor market, they're all taking that as a bit of a more positive news per se. Earlier this week, we did see the producer price growing much faster than expected. It was growing by 9.6%, which is the 13 years high. And that might affect negatively in terms of the operating profit margin for the companies. But it seems that people are taking this as consumers are in a good position to purchase more, and therefore the consumer price index rising at a faster speed means that margins for the companies can remain sustainable. So they're pretty much looking at labor market as well as the economic growth rate to be quite reasonably well going into the future. As you know, the Fed have revised up the economic growth rate for year 2023 from 3.8% to 4%, despite that they lowered the interest expected growth rate for this year. But all in all, this means that most of the economy as well as the financial market is taking this news as something that is moving as accordingly, moving away from the COVID-19 crisis, and that most of the economy will be normalizing going into next year.
And Korean stocks started out with a sizable gain this morning, too, but tapered that by the end of the session. The Kospi back above 3,000 points, though. Some of the winners today were pandemic-related names. Tell us about the domestic market.
Yes, if you look at the Kospi, it did start it up quite strong, and it did go up to well above 3,010 territories, and then it did go down to as low as below 3,000, and then towards the last 2 hours of trading, it did recover to 3,006 plus. So Kospi was up by 0.57%. And also Kosdaq was up by about 0.43%. However, though, if you look at the overall flows of the purchases, it is good news that the foreign investors are the ones that net buying the Korean market. Foreign investors totally bought about 183 billion won worth of Korean Kospi, and also about 10 billion won worth of Kosdaq as well. If you look at the overall currency market, despite that we saw Korean won going up to as high as 1190 plus, it did recover, and that it appreciated to 1184. This is basically the currency swap between U.S. and Korea was, accordingly gone down quite well, even though previously it was kind of a bit worrisome that it might not strike the deal. But it did. So therefore, the currency stabilized and the Korean market stabilized, and foreign investors are the net buyer of the Korean market. If you look at the other numbers that are coming out from the Korea, the unemployment ratios and most of the other economic numbers seems to be quite reasonably well for Korea. And inflation is a bit of an expansionary, but nevertheless, we think that the Korean economy can sustain that kind of inflation for the time being. So all in all, the overall Korean markets were moving accordingly with what happened to U.S.
Right, and speaking about the Korean economy, the government is still shooting for 4% growth for this year, a target that's put in jeopardy by the resurgence of the pandemic. But Finance Minister Hong Nam-gi is saying they're going to try to make that happen with fiscal spending here at the end of the year. And next year, he says, growth will be in the low 3% range. But the challenge to these targets is, of course, the damage done by the reintroduction of strict social distancing. So how do you see growth panning out for Korea?
Right. As you said, if you look at the third quarter GDP growth rate of Korea, it did grow by about 4% year on year on third quarter, which is slowing down from the decade high of 6% growth in the preceding quarters. And it is slightly lower than the consensus forecast of 4.2%. So obviously, the current government has a target that might be difficult to achieve unless they try to do a lot more aggressive measures right after the presidential elections. The question mark is that whether or not the current regime will continue to be in power, and therefore they can boost up the fiscal policies. Despite that, if you look at the monetary policies, it's not going to change much, right? If you look at the interest rate environment, BOK raised interest rate twice this year, and they're planning to also raise interest rate twice again next year. So in terms of the monetary policy and the speed of tightening, it's not going to change much. So what that means is that in order to achieve a 4% growth rate of GDP, clearly you need aggressive fiscal policy boosting measures. And that's not going to happen unless, the presidential election is over, and also the Senate's supportive of the boosting measures. All that needs to be possible. Also, you need to see how the consumer debt problems can be resolved with the government's gradual changes in terms of regulatory environment. If you continue to tighten the policies and the consumer lending is not happening or rollover is difficult, then that could be very negative news for the domestic consumption growth rate. So therefore, it's a tough year for 2022 for Korea. Obviously, government has a lot to do in order to achieve that target of 4%.
Certainly, it's a complicated situation, Mr. Yu. Thank you, as always, for helping us understand that. We appreciate your insights.
Thank you very much.